complication. My name is Alex Peel. I'm a partner at James Cooper Creston, and today I'm joined by my colleague James Pitt, who's a director in our audit and assurance team based in our Oxford office. We're going to take you through a number of aspects of the new microentities regime and look at why it's relevant for you as businesses, whether you qualify, what is a microentity, some of the key differences in the accounting rules between microentity accounting, where it might be useful, but also possible issues arising as well. At the end of the webinar, there'll be a chance to have some questions answered, and I believe on your screens you should be able to have the facility to ask questions as you go along, but we will wait to the end before we answer those. Hopefully we'll have time to do that. I should also say that once the webinar is complete, after a short period of time, you should also be able to find it on our website. So if you know someone who's not been able to attend today, they can just go onto our website and download and listen and view the webinar. Before we get going then, I just want to ask a quick question of everybody who's attending. And that question should appear on your screen. You've got three options to answer that question, and the question is, do you think that current accounting requirements for small companies are too complicated, oversimplified, or just right? And at the moment we're talking about before the changes in rules, so the rules that we've been using for the last 10-15 years. If you can vote now, we'll just have a couple more seconds before we finish this poll. And then we'll just look at the answer before we move on. So few more seconds, and we'll close that there. And 64% of people actually think that before the changes, the rules for small companies were just right. 21% thought too complicated, and actually a reasonably similar number, 14%, thought that they were actually oversimplified. So that's quite interesting. But it was interesting that people thought that they were just right. It would be interesting if you've once you've listened to this today to see what people's views are on the new rules, especially if you've also listened to our webinar on other parts of the new small companies regime. Anyway, why is this all relevant? So, as you may well be aware, something that we've had for at least 15 years, the financial reporting standard for smaller entities, has recently been withdrawn. And for periods beginning on or after the 1st of January 2016, there are now a number of new choices. Companies can choose to use the FRS 102, Financial Reporting Standards 102, provisions for small companies, which are found in section 1A of FRS 102, or another option that they now have is the microentities accounts rules. These rules have been around for a while now, since 2013, and they've been formalised as part of the review of UK GAAP, and now we have something called FRS 105. Again, that applies for accounting periods beginning on or after 1st of January 2016, but early adoption is allowed. And FRS 105, it contains the accounting rules for microentities. As I mentioned, there is another alternative, and later on in the webinar we will look at the differences between the various sets of rules that are available. I'll also mention at this stage that we have recently prepared a webinar on the FRS 102 section 1A rules for small companies, and that is on our website. So if you missed that and you want more information about those rules, then do go onto our website and have a look at that webinar. Today we'll focus on the microentity rules. Okay, so to start off with then, really, what is a microentity? Some of you might think, actually, I might log off now if you're not a microentity, although hopefully you'll be interested to find out what the new rules are anyway. So a microentity must meet at least two of the three conditions which are listed out on your screen. You should be familiar with the types of condition because they've applied to companies over many years now. So we look at turnover, balance sheet total, i.e. gross assets, and the number of employees. And in the case of a microentity, turnover must not be more than 632,000, a balance sheet total of not more than 316,000, and average number of employees not more than 10. What you have to do is, for an established company, meet the conditions for a period of 2 years, but a company in its first year will qualify if the conditions are met in that year. In the case of a company which is a parent company, the company qualifies as a microentity in relation to the financial year only if the company is a microentity, obviously, in relation to that year. The group headed by that company qualifies as a small group, and there's various rules as to what is a small group, and also that the company has not voluntarily elected to prepare group accounts. So if you do want to prepare group accounts, albeit that you don't have to as a small group, you can't use the microentity rules to prepare those group accounts. The only rules in that case that would be available are the larger set of rules under FRS 102, and there's no provisions for preparing those accounts under the FRS 105 rules. So moving on, in addition to the types of entity or the sizes of entity which can't use the microentity rules, there's also a number of other exclusions from the regime. I mean, again, if you're familiar with company sizes and company financial reporting requirements over the last many years, in fact, most of these exclusions won't be a surprise. So, for example, if you're a PLC, you can't use microentity accounting rules, and many of the others down here are similar to companies which have been excluded from various exemptions in the past, particularly from using the financial reporting standard for small entities. So you can see them on your screen. So companies carrying out insurance market activities, various financial services companies, members of a group which is ineligible. As I've already mentioned, parent companies preparing group accounts can't use the microentities rules. Non-parent companies that are included in consolidated group accounts for that year can't use them, and then various investment undertakings and financial holding undertakings, credit institutions, insurance undertakings, and also charities are specifically excluded. We're not really covering charities today. As you'll probably know, they have their own set of, or sets of accounting rules. They can't use the microentities regime. I'm now going to hand over to James, who's going to take us through more about what's in a set of microentity accounts and also some of the differences between microentity accounts and the fuller rules.
Thanks, Alex. So as Alex said, I'm going to talk through what's included in a set of microentity accounts. So a director's report is included in a set of microentity accounts, although it is worth noting that there are small company exemptions available, which means that the director's report will consist of little more than the director's names and the fact that the microentity has taken advantage of the exemptions. There are 2 optional balance sheets for a microentity to choose, and also a profit and loss account. And there are also a couple of notes that are required to be in a set of microentity accounts, and these must be included on the foot of the balance sheet. These notes that have to be included are directors' benefits, advances, credits and guarantees and other financial commitments. Although simplified, the general rules and accounting principles of the small company regulations must be applied. This means that the company or microentity must apply accounting policies consistently, must prepare the accounts on a going concern basis, assets, income, liabilities and expenditure should not be netted off, and comparatives should also be included within the microentity accounts. It's worth noting that full microentity accounts can be filed at Companies House. However, there's also an option for microentities to exclude both the director's report and the profit and loss account, which means little more than the balance sheet will be submitted at Companies House. The concept of abbreviated accounts does not apply to micro-entities, so micro-entities can produce full micro-entity accounts and then submit abbreviated accounts. However, the micro-entity accounts without the director's report and profit and loss account is very similar to a set of abbreviated accounts. So I'm just going to talk you through an illustrative set of financial statements. So we have two pages. The left-hand side is the contents page, and as you can see, it is quite brief. The second page is a profit and loss account for a micro-entity. Some of the key differences between the micro-entity accounts and another framework such as the FRSSE, you'll notice that there's no subtotals such as gross profit, operating profit, profit before tax, and profit after tax. Other than that, the headings and classifications are very similar. Turning on to the next page, we have an example of a balance sheet prepared using micro-entity accounting. As you will see, the called up share capital sits on the top of the balance sheet, which is different to current accounting frameworks. And then one of the key differences is that balances are not disaggregated. For example, current assets is not split out between trade debtors and other debtors. The amounts are amalgamated. Going down the balance sheet, a lot of the classifications should be familiar. And then at the bottom, the balance sheet balances to capital and reserves, which is not disaggregated. You'll see the notes to the accounts on the bottom of the balance sheet. As mentioned, the two notes are required: directors' benefits, advances, credits and guarantees, and also financial commitments, guarantees and contingencies. On the right-hand side of the screen, you'll see a statement that the company is entitled to audit exemption, and then the director's responsibility statement. So what are the key differences between FRS 105, micro-entity accounting, FRS 102, the replacement for UK GAAP, and the FRSSE, which Alex has already told us that will become redundant for future account periods. So in terms of the true and fair view, under FRS 105, financial statements prepared using micro-entity accounting are presumed to show a true and fair view, and no additional disclosure requirements are necessary. This differs to both the FRSSE and FRS 102, where the directors have a legal obligation to ensure the accounts show a true and fair view, and additional disclosures must be included where necessary. In terms of the format of the accounts, within a set of FRS 105 accounts, you would expect to see a director's report, profit and loss account, balance sheet, and limited notes, as we've just discussed. Under the FRSSE, you would expect to see a director's report, profit and loss account, balance sheet, statement of recognised gains and losses, accounting policies, and also notes of the accounts. And under FRS 102, which is for larger companies, you would expect to see the statements are included within the FRSSE plus additional statements such as the strategic report, a statement of comprehensive income, a statement of changes in equity instead of the statement of recognised gains and losses, and statement of cash flows. As I mentioned previously, under FRS 105, no disaggregation of the balance sheet is permitted, and therefore items aren't disaggregated and shown in order of liquidity, whereas under both the FRSSE and FRS 102, the balance sheet is disaggregated, so various components are split out within each category, such as taking tangible fixed assets, for example. Tangible fixed assets would be split into intangibles, tangibles, investment properties, etc. In terms of disclosures, FRS 105 requires the disclosure of the advances, credits and guarantees to directors, and also details of financial commitments and contingencies. Both the FRSSE and FRS 102 require significantly more disclosure depending on what's included within the financial statements. Fair value accounting is not permitted under FRS 105, whereas currently the FRSSE allows the fair value accounting to be applied to certain categories. and also FRS 102 permits these fair value accounting rules, but also fair value accounting is compulsory in certain areas, such as financial instruments. In terms of accounting policies, under FRS 105, there are no real choices, and transactions will largely be recognised in the profit and loss account rather than deferred in the balance sheet. This differs from both FRSSE and FRS 102, which allow companies to choose certain accounting policies, particularly around whether to expense or capitalise development expenditure, and similarly to expense or capitalise borrowing costs if certain criteria are met. Company law, so both the FRSSE and FRS 102, the requirements of the Companies Act have been reproduced in the accounting frameworks, whereas under FRS 105, not all the company law requirements have been reproduced, only those that relate to the financial statements. One of the key differences that will be useful for lots of micro-entities, under FRS 105, deferred tax does not need to be provided for, and this differs to the FRSSE and FRS 102, where deferred tax has to be recognised. I'll just pass you back over to Alex.
Okay, thanks very much, James. I think it's just worth summarising at this stage the choices available to a company that qualifies as a micro-entity. We put up the various limits earlier, and if you're a company that doesn't fall within one of the other exclusions, then you can prepare micro-entity accounts. So you've got that as your first choice. You've then got Financial Reporting Standard 102 Section 1A, which, as we mentioned earlier, replaces the FRSSE. FRS 102 Section 1A is effectively a cut-down version of FRS 102, and that the disclosure requirements are more limited. However, the accounting policy requirements of FRS 102 Section 1A are the same as FRS 102. So you could also choose that. You could apply full FRS 102 if you wanted to, and if you really wanted to, you could also apply full IFRS. But I just thought it'd be worth setting out those four choices which are available. So why might microaccounting be useful? I think when they introduced these new rules, the Department for Business Innovation and Skills, in their impact assessment for the microentities regulations, they note that the bulk of benefits arising are non-monetised and occur due to the simplification and additional choice conferred on microentities. Government often links simplification to additional choice. I'm not certain whether having lots of choices does make life simpler for people, because choice generally often leads to people being a bit more confused. But biz at least do believe that choice is a benefit of this. I think in terms of the simplification of accounts formats, the accounts will be shorter, they'll need less paper, they hopefully will, in some respects at least, be easier to understand because they are shorter and present all of the information in fewer pages. However, I think just because there's fewer notes doesn't necessarily mean that they'll be easier to prepare, because the bulk of the time will be spent in working out the numbers that go in the accounts, and in the past many of the notes that have been included have really just either been standard wording or fallen out of the work that's already been done. So yes, they'll be shorter, hopefully easier to understand for some, and there'll be less disclosure required. I think the other really useful benefit for some companies, and we haven't explicitly put it on the screen here, is the simplification of accounting. So James mentioned some of the areas where there are differences. So things like the revaluation of property, that's just not permitted by the microentities rules. So if in the past you've been an investment company with investment property, you've been required to value that property at fair value and include it on the balance sheet at a valuation. Going forward, that property will just be included at its cost. Things like deferred tax, as James mentioned, deferred tax doesn't have any place in a set of microentity accounts, and so you don't have to include it or indeed calculate it. Again, that may well be a considerable time savings, especially with the new FRS 102 rules, which mean that deferred tax is now provided on many more balances. Share options is another area. In the past, small companies haven't had to value share options and include those in their financial statements. Under the new FRS 102 rules, that exemption's gone. However, microentities still can take that exemption. So if you're a small company with share options, microentity accounting might be attractive for you. And then things like financial instruments. I know that's a word that often people don't like very much. Another one is derivatives, but here we're talking about things like intercompany balances, which are due after more than 1 year, or things like forward exchange contracts, which under certain circumstances and under FRS 102 rules, you actually need to now value in a slightly different way, or in the case of derivatives such as forward exchange contracts, bring those onto your balance sheet. Microaccounting rules don't need that at all, and will allow companies with those sorts of balances to prepare a much more simplified set of accounts. Possible issues arising though, loss of transparency. I think nobody's really had these sorts of accounts in the past. I think when the rules were brought in, they had a very mixed reception from various professional bodies because they were thought to not necessarily be a proper set of accounts that show a true and fair view because of the fact that some of the balances that we've just alluded to are missing. Linked to that, credit rating agencies, for example, may not understand them. It remains to be seen whether banks will accept them because they are different and don't necessarily include all the same balances as a full set of small company accounts. There are sort of arguments as to whether the quality of the underlying financial statements will be as good as if you were preparing a set of FRS 102 Section 1A accounts. I think moving on from whether the accounts show a true and fair view and are a proper set of accounts, other issues possibly relate to the companies that might move between the microentity rules and sort of just not qualifying. So if you had a company that 1 year qualified as a microentity and then didn't in subsequent years and then again fell within the microentity regime, and you were a company that had differences in the accounts that would be prepared under the two accounting regimes, that could cause a lot of confusion and prior adjustments going here, there and everywhere to bring yourself into the microentity regime and then take yourself out of it again when you no longer qualify. So that's a possible issue to be aware of. Otherwise, just generally a lack of choice. As we've seen, the microentity rules are far more prescriptive in terms of the accounting policies that you must use. There's a defined set of standards and you must stick to those. You can't vary from it. So, for example, it might be an advantage for you not to have to revalue your property, but actually some companies like doing that because they want to show a strengthened balance sheet, they want to show a better position. However, if you're one of those companies and you choose micro accounting, you can't do that anymore. Other areas, for example, R&D, under the current rules for small companies and indeed under the FRS 102 1A and full FRS 102 rules, a company has choices to how to treat research and development expenditure. Either you can capitalise it within the balance sheet and then amortise that, or you can choose to write it off to your profit and loss account over in the year that the expenditure was actually incurred. So you do have that lack of choice under the microentities rules. However, I think there are a number of pros and cons, and I think all companies that might qualify for the new regime need to consider whether microentity accounting is something that is suitable for them. Obviously, they need to be aware of the key differences in the accounting rules and the possible issues arising, but of course, if you speak to us, then we'll be able to take you through those. So before we close and sort of move on to any questions, I just thought it'd be interesting to do another poll now. And the question this time is, will you, or sort of based on what you've heard so far, and assuming you qualify, of course, will you be looking to apply micro accounting? And the questions this time are yes, no, or don't know. So do vote. We'll keep the poll open for a few seconds. I think half of the attendees have voted so far. We're nearly there. A couple more seconds and we'll close that. And quite mixed results actually. So of those who voted, 43% think they will look to apply the rules, 29% say they won't, and also 29% don't know. And I'm sort of not surprised at the don't know, because obviously companies will be very individual and very specific, and they will need to consider the pros and cons before they make a choice. So that brings us to the end of our presentation today. If there are any questions, then do ask them. I think we've got one question in there that has come through, and that question surrounds accounting for R&D expenditure. And the question, I think it probably came in before we covered the point, but the question is, do I still have some choice as to how I account for this? Because in the past I've been able to either capitalise it or write it off to the profit and loss account. James, would you like to just sort of clarify that point?
So as we've already alluded to, under micro entity accounting FRS 105, companies lose the option to capitalise development expenditure. So whereas under both the FRSSE and FRS 102, a company can either capitalise it if certain criteria are met or expense it, that option goes away if micro entity accounting is applied, and the expenditure would have to go through the profit and loss account, which as Alex was referring to earlier when talking about investment properties, that could have the impact of not, or making the balance sheet looking slightly worse than if the development expenditure was capitalised.
Okay, thanks James. So we haven't got any more questions, but I think this is a thing that if you do qualify for the new rules, it's really worth speaking to your normal contact at James Cooper Creston about. If you don't have a contact, then you've got our contact details up on the screen there, and do get in touch if you want to discuss this. It is quite new and quite different, and there are some significant differences that will arise. So I'd like to thank you very much for listening. I think most of the people who joined at the start have stayed with us all the way through, which is hopefully means that we've been talking about something useful. And just to say that, as mentioned earlier, this webinar, along with various others, will be on our website shortly in a few days' time. So thank you very much, and enjoy the rest of your day.